welcome back to my channel. So in today's video, I'll walk you through some option strategies specifically tailored for small accounts under $2,000 aimed at helping beginner traders grow their capital while controlling risks effectively. So let's go ahead and jump right into it. So the first thing to note is that when managing a smaller account under 2K, every single move carries weight. With limited capital, you can't afford to take reckless risks, and over-leveraging can potentially diminish an account faster than you think. Now, why this matters is specifically because over-leveraging is one of the quickest ways to exhaust a small account. If you put too much capital into a single trade and the market moves against you, your account balance can take a major hit, sometimes beyond recovery. Now, small accounts should prioritize longevity over rapid gains, and I'll talk about that more throughout this video. But a good rule of thumb is to stick to risking anywhere between 5% to 10% of your account per trade just to preserve your capital. So on a $2,000 account, that means risking no more than $100 to $200 per trade. So focus on risk-defined strategies where your potential loss is capped before you enter the trade. And you can also avoid stocks with extreme volatility unless you have a structured approach and a clear risk plan preset. Because if you're brand new to trading, those extremely volatile stocks can actually offer a great amount of money, but a great amount of risk as well. Simply because sharp price swings can be unforeseen, and without a solid strategy, they can completely reduce an account fast. So it's a good idea to prioritize consistency over chasing big wins because small calculated gains add up over time. Now with that in mind, this brings me to the next point, which is of course being mindful of overtrading. Overtrading can burn through a small account quickly, not just through unnecessary losses, but also from excessive commissions and fees. I always recommend that every trade should have a clear purpose. So taking too many trades out of boredom, frustration, or FOMO, it can lead to impulsive decisions and it weakens your overall strategy. Now with small accounts, this requires precision and most importantly, patience. And because of that, it is good to prioritize quality over quantity. So you want to focus on high probability setups rather than trading just to stay active. More trades don't always mean more profit. Sometimes they mean more unnecessary risks. And because of that, you should also track your trades. So if you keep a trading record to analyze past decisions, you can also spot patterns and you can identify mistakes or habits that need to be adjusted. Reviewing your trades helps refine your approach, and it also helps to avoid repeating errors over and over again. It's also good to know that you should understand cash account rules. If you're trading with a cash account, remember that funds from a trade take time to settle, typically 1 to 2 business days after the trade date. So be strategic with your capital allocation because this allows previous trades to settle before jumping into new ones. This also prevents tying up your account with unsettled funds and ensures you're always in a position to take advantage of quality setups as you see them. So next up, it's important to focus on liquidity because you want to prioritize this within your trades. Now, liquidity plays a major role in how efficient you can enter and exit trades. If an option is illiquid, you may struggle to get filled at a favorable price, and the low liquidity can make it harder to get in and out, forcing you to take a worse fill or wait longer than expected. So it's a good idea to look for high open interest. You want to aim for options with at least 3,000 plus contracts in open interest. This ensures that there are plenty of active traders buying and selling within the market, reducing the chances of getting stuck in a trade. You also want to avoid thinly traded options. If an option has low open interest and low volume, it can be difficult to close at a reasonable price, forcing you to take a loss or accept unfavorable pricing just to exit. Because even if an option has high open interest with low volume on the day you're trading, this could lead to execution delays or unfavorable fills as mentioned. So you want to look for options with consistent trading activity that is high. Now, along with that, you also want to stick to tight bid and ask spreads. And because that's so important, wide bid-ask spreads can undermine your profits before the trade even moves. So the more liquid the option, the easier it is to manage the risk, take profits, and avoid unnecessary losses due to poor execution. A close spread helps prevent excessive costs because wider spreads mean you're in essence not at the highest advantage just by getting in the trade. So what this means is that with a wider spread, you're paying more to enter and exit, which cuts into the potential profits that you could make. So it's always beneficial to trade liquid stocks and ETFs as a beginner because you're seeking to grow your account. It's a pretty good idea as well to stick with fairly well-known names that have strong daily volume, such as like Apple, QQQ, or SPY. These stocks typically offer smoother executions, minimal slippage, and more projected price movement. Now, keeping that in mind, you always want to know your risk and stick to defined risk strategies. A common mistake among beginner traders is focusing a little too much on potential profits while ignoring the risks. The reality is, consistency in trading comes from managing losses, not just winning trades. For small accounts, one bad trade using an undefined risk strategy can clear your capital completely. But defined risk strategies, on the other hand, they put a hard cap on your potential loss, which allows you to trade and protect your account from drastic drawdowns. So you want to know your max loss before entering any trade. So you should calculate how much you could lose in the worst case scenario and make sure it fits within your overall risk tolerance. So let me just say this, if the risk feels uncomfortable, the trade is too big, and you definitely don't want to ignore that feeling. You want to use probability-based metrics, so tools like the delta, of course, it can help estimate the likelihood of an option expiring in the money, which gives you a better sense of the trade's risk versus reward. So with that, you want to implement stop losses and or trailing stops. Now, you ideally want to set predefined exit points to protect your money just from the get-go. A stop loss really just prevents you from holding on or losing trades too long, while a trailing stop helps lock in profits as a trade moves in your favor. And of course, y'all know I made a dedicated video about this, so I'll leave a link for it down below. And the last thing to note on this is that you want to avoid undefined risk strategies unless you fully understand the risk. So if at any time you're uncertain about taking on a level of risk, the best choice is to stick with strategies that are familiar that have built-in protection. Now, with that being said, you definitely want to prioritize the risk to reward ratios for steady growth. When trading with a small account, every trade needs to be worth the risk, in my opinion. If your potential losses are equal to or greater than your potential gains, it becomes difficult to grow consistently. A strong risk to reward ratio ensures that even if some trades don't work out, the winning trades will more than make up for it, because the goal is to trade smarter, not just more often. So on the screen, you see I have an example illustrated. As a new trader, you want to target a reward that's at least 1.5 to 2 times your risks. So if you risk $50, aim to make $100 plus on a trade. This way, even if you only win half of your trades, you're still net profitable. And this also helps to avoid trades with low upside and high downside. And what this means is that just because a trade feels safe, it doesn't mean that it always is. As mentioned, if the potential loss is equal to or greater than your potential gain, you're setting yourself up for slow or no progress at all. So you want to avoid that completely. And because of that, one of the things that I always mention is that you should stick to high quality setups. Sometimes the best trades take time to develop, so you don't want to jump into low reward trades out of impatience. You want to wait for the opportunities where the potential profit justifies the risk. Because it's all about thinking long term. The goal, again, is consistent, calculated growth, not just avoiding losses in the short term. And that's why trading with a strong risk to reward ratio mindset helps protect your money while positioning you for steady account growth. And with that being the focus, you definitely want to start small and then scale up strategically. One of the best things that you can do when you're trading with a small account is that you want to first prioritize protecting your capital. So it's a good recommendation to begin with small position sizes. Trade 1 or 2 contracts per position to keep losses manageable while you build your experience. And this helps you stay in the game longer and avoid emotional decision making. You can then increase size only when consistency is proven. So if your strategy starts delivering steady profits, gradually scale up by adding more and more contracts, but only as your account allows. You also want to avoid overextending too soon. So growing too fast with a solid foundation can lead to bigger losses than your account can handle. Expansion should be a measured process, not an emotional reaction to 1 or 2 good trades. And to be honest, we've all been there. We've all done that. So just keep the goal in mind to build a strong trading approach that allows you to scale up safely. So when your account is larger, you're not just making bigger trades, you're making better trades. Now moving on, one aspect of this that is extremely important as well is to trade options on affordable stocks to maximize capital efficiency. And this means that capital preservation is essential, and trading options on more expensive stocks like Amazon or Tesla, for example, can be tempting, but they can also quickly erase funds due to their high premiums. Options on lower priced stocks offer a cost-effective way to participate in the market without overdoing it. So for instance, by focusing on affordable contracts, you can manage your risk better, take multiple trades, and stay flexible in your strategy. And one way to go about staying in a range is to target stocks priced between $100 and $250. This range typically offers reasonably priced options while still providing good liquidity and movement. But as mentioned, ensure that the options have a good significant amount of momentum because you want to prioritize strong technical setups. So choose stocks that have consistent price action and well-defined trends so you're not stuck trading choppy or consolidated moves. And along with that, consider ETFs for diversification. ETFs like QQQ, SPY, or XLF, they provide reliable options volume, making them solid choices for small account holders. And on the other hand, you want to avoid stocks with extremely low prices. While cheap stocks may seem attractive and tempting, their options often have low liquidity and wide bid-ask spreads, making some of them, not all, but some of them are harder to trade to be profitable. So with that, I definitely wanted to provide an example so you guys can see at least a few stock ranges within these categories for liquidity purposes. So within the chart on the screen, at the top left, you can see the first category for the price range is $100 to $150. And two really good stocks that fit within this range, at least at the time of filming, are going to be Apple and Nvidia. These stocks offer the opportunity for you to see a good amount of momentum shift and gain while also having enough liquidity to be profitable. And then underneath that, you see the range from $150 to $200. And Microsoft and Google fit into this category. Last but not least is going to be $200 to $250. These are going to be consistently active options with high momentum. So good examples of this are going to be Amazon and AVGO. Okay, so next up, it is important to also focus on leveraging time decay to your advantage. As I've mentioned in several videos before, options lose value as they get closer and closer to expiration, and this is due to Theta. Meaning if a trade doesn't move in your favor quickly, as it approaches that time of expiration, your contract could lose value very rapidly. Managing Theta properly allows you to maximize gains while minimizing unnecessary losses from the time decay itself. For day trades, as y'all know, I recommend choosing in-the-money options because in-the-money options have higher intrinsic value and lower Theta decay, making them less vulnerable to rapid time-based losses. And honestly, this just helps capture cleaner moves without your contract losing value as quickly. Now, in reference to short-term swing trades, you may want to consider options with 20 to 40 days to expiration if you're comfortable with that time frame. And this just gives your trade enough time to play out while still allowing you to capitalize on price swings. It also provides flexibility to adjust or exit without getting squeezed by Theta. It is good to note that you want to avoid holding options too close to expiration unless you're expecting a major move. As expiration nears, time decay accelerates, meaning your contract can begin to lose more and more value, even if the stock moves slightly in your favor. If you must hold close to expiration contracts, ensure that the trade has strong momentum. So the important thing to note on this is that you want to be mindful of implied volatility changes. If the IV drops while Theta is working against you, your contract could lose value faster than you expect. So you want to choose setups where both time decay and volatility work in your favor as much as possible. So the next thing to consider is that you want to use weekly options strategically to manage risk and maximize opportunity. Now, weekly options can seem attractive because of their low cost and potential for quick gains, but their short lifespan makes them a cautious choice. So to trade weekly options effectively, you need a clear plan. The first thing you want to do is be highly selective, so don't overlook strong momentum, key technical levels, or catalysts. Now, it's important to stay up to date and stay in the know on events like earnings, product launches, or economic reports that can create sharp price movements. If the catalyst is positive, consider calls. If negative, you want to consider puts, but only if this setup aligns properly. As a general rule that a lot of traders follow, you may want to avoid trading on unfavorable earnings or news-driven stocks unless you're counter-trend trading. If a stock has a history of wild swings with no clear direction, especially during a week that they're reporting earnings, it's often better to sit out rather than gamble on a volatile move. Now, if you do choose to trade during this time, you want to make sure you use tight stop losses and set realistic profit targets. Because again, time decay is aggressive and small gains add up. but holding on too long can turn a winning trade into a loser fast. And keeping aligned with this, it's also important to test your strategies before trading live. My biggest tip to new traders is that instead of learning through costly trial and error, backtesting allows you to refine your strategies in a risk-free environment. By analyzing historical data, you can see how a strategy would have performed in different market conditions before putting real money on the line. And this helps build your trading techniques and reduces unnecessary losses. So you want to use backtesting tools like Thinkorswim or TradingView to simulate trades that can help you evaluate whether your strategy is effective or not. You want to also then identify patterns and refine your setups. This goes along with reviewing your past trades to see how often your chosen strategy would have worked. If a setup consistently fails under certain conditions, it's so much easier to make adjustments before trading it live. Another really good tip is to test different strategies under different market conditions as well, because a strategy that works in a trending market might struggle in a choppy one. So you want to backtest across the bull, the bear, and the sideways conditions to understand how your approach holds up. You can also track key performance metrics, so you can look at your win rate, risk to reward ratio, and maximum drawdown to determine how well your strategy performs over time. If the data shows consistent losses, you definitely want to reconsider your approach. And although some people may be against it, you can use paper trading as a next step. Once a backtested strategy shows promise, practice it in real time using a demo account before committing with real money. That way you can kind of remove the emotion from it. And this also helps bridge the gap between theoretical success and live execution. Now, I don't recommend that anyone paper trades for an extended amount of time because it can mess with your trading psychology, but it is good to practice if you're just getting started. So the main importance here is that backtesting is something that even pros utilize to develop a profitable trading approach, and it's useful for all traders, especially those with a small account. The goal isn't just to find a strategy that works, but to understand why it works and why some others may not. By testing and refining your setups before going live, you'll trade at a higher level and hopefully minimize costly mistakes. This then brings me to my next point, which is of course practicing patience and staying committed to the process. Now, when trying to grow an account from $2,000, it's important to note that it is not going to be an overnight success story. Trying to rush the process by chasing big wins or shortcuts often results in unnecessary losses, especially with inevitable price fluctuations. And as I've mentioned before, consistency is the key to building wealth over the long run, and small, smart trades will get you further than guessing on huge moves. And this can be one of the examples that many traders use by focusing on growing their accounts from anywhere to 15 to 30% per month. Now, this is doable, and it ensures that you make decisions that support long-term growth. What this means is that you're compounding your small wins. The consistency within this of the smaller gains, they add up pretty quickly. So for example, if you're starting with $2,000 and your account is growing at 30% per month, you can 10x your account in less than a year, and this allows you to let your progress snowball. So with this example, if you maintain consistent 30% growth each month for 6 months, your account could grow to over $9,500 without any withdrawing of any profits, of course. And this just illustrates the power of compounding small, consistent wins over time. And that's why it's best to trust the process and avoid impulsive decisions. Even when the market moves fast or offers tempting opportunities, again, stick to your plan and resist the urge to chase. Because small incremental steps will lead to bigger results than trying to chase shortcuts. So honestly, just let time work in your favor. So to further illustrate this example, I wanted to provide a breakdown of what this would look like with the power of compounding and growing a 2K account at a 30% monthly rate. So analyzing the example on the screen, if you start with that capital investment of $2,000 and you multiply that, at the end of the first month, you would have $2,600. At the end of month 3, you would have just a little over $4,000. And then at the end of month 6, you would have just a little over $9,500. Now, assuming you stay consistent with your strategy and let your profits build, this growth trajectory for an entire year can equate to over $20,000 because by month 12, you would be at $23,746. So by the end of the year, that $2,000 that you started with could grow to be more than 10 times your initial investment. And this highlights how discipline can turn modest gains into significant wealth over time. And really, it just demonstrates the importance of sticking to your strategy for long-term success. Now, finally, the key considerations for sustainable growth is going to be a solid strategy, a keen focus, and of course, you want to make sure you're looking at growth like this that stems from a calculated approach that keeps your capital intact through ups and downs. So the overall takeaway is to avoid overtrading, keep sound risk management, set realistic expectations, and compound your growth every single month. Just remember, the road to high earnings is not always linear, and there will be months where your returns may be less than expected. The focus is not to rush the process, but to trust that small, consistent gains will accumulate over time. And if you're new to trading and starting with a small account, just know that it can be challenging. Again, we've all been there. But stay patient, stick to your plan, and keep in mind that sustainable gains is a marathon, not a sprint. And with that, that'll pretty much do it for this video. If you found any of this information to be helpful, don't hesitate to leave a comment down below. I thank y'all so much for watching, and of course, I'll see you in my next one.